We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
When I outlined Making Money Simple, I wanted to give readers a clear starting point, focus only on the most important decisions to make, and share my savings system that quietly nudges your finances in the right direction without regular effort on your part. The book is broken into 3 parts. The first section is all about goal setting and building a system for financial success. The second section focuses on investing, and the third section is about big financial decisions that happen infrequently but are important to get right. I covered the first 2 sections in the prior 2 episodes, so this episode is the third and final installment of this series, so let's dive right into those big financial decisions. Chapter 10 is called Family Finances. And even if you don't have a family, don't skip ahead, because this chapter still has something for you. There's a lot of information on buying a home, which certainly applies to a variety of people in different stages of life. For example, the decision to rent or buy a home is arguably one of the most important financial decisions you'll ever make. And it's important to get right. Plus, maybe one day you'll have a significant other. When you're single and you manage your finances in a way that's comfortable and that you understand, no one has to approve or disapprove of your financial decisions. Couples, however, they have to agree on a system for budgeting, paying bills, and saving for the future. Everyone feels differently about their finances, and different money personalities, levels of income, they all require unique strategies. So in this chapter, I lead off with offering a couple different strategies that can serve as a starting point for combining your finances and can be customized to better fit your situations. Now, before I share these strategies, one quick call out is that these different money models are intended for couples who are married or have committed to some sort of life partnership. For couples living together who have yet to lock it down, I'd say it makes more sense to keep your finances separate and divvy up joint expenses as you see fit. So here are the 3 strategies I usually offer new couples. The first is just the keep it simple, joint accounts for everything strategy, where you use joint accounts, you combine everything. Good communication is essential, and so you have to maintain an open dialogue about money. So for example, maybe you have a spending threshold that requires spousal notifications. For example, I'll sometimes throw out to new couples, why don't you guys just tell each other about purchases above $250? I don't know what the right number is for everybody, but pick a number. And it isn't intended to be an approval process where the other spouse gets to sign off on a purchase before it's made, but just a way to ensure that the lines of communication remain open. A second strategy is the more of what's mine is mine, where you keep separate accounts for income and spending. So this is the complete opposite of merging your finances. You maintain separate accounts and you divvy up joint expenses and enjoy total freedom over your own finances. Although having similar incomes makes this a lot simpler, couples with different levels of income can separate finances by assigning the more expensive items like a mortgage to the higher earner and utilities to the lower earner, for example. But things tend to get trickier when something like saving for retirement or paying down debt comes up. So it's definitely not a set it and forget it solution, because life and your finances, they definitely get more complicated over time. I'm personally more of a fan of a hybrid type model where you're allocating income to both joint and individual finances if you decide that merging your finances is not going to be for you. So the hybrid approach allows each spouse to have some money of their own while most everyday expenses are paid out of a joint account. Now, one way you can divvy up how much you put in the joint account versus your own is based on a percentage of your income. So let's say both spouses put 80% of their income into a joint account and 20% into a personal spending account that they hold separately. And the joint account would cover everyday expenses like mortgage, groceries, meals together, vacations, medical bills, long-term savings, etc. Whereas the personal spending accounts might cover items like clothing or personal electronics, gifts, trips without the other spouse, etc. When trying to determine the right percentage, I'd thrown out 80% to joint, 20% to personal. That's just a starting point. You can tailor it to your circumstances. And couples with large income disparities may decide that one spouse having way more personal spending money doesn't make sense. So maybe one spouse would put 80% towards the joint pot while the other puts in 40%. But that's perhaps maybe why there's another hybrid model that I explain in the book called the fixed dollar model, which allocates a specific dollar amount to each separate account, and then the rest goes into the joint account. So say one person has a monthly after-tax paycheck of $10,000, and the other person's bringing in a monthly paycheck of $5,000. In this case, maybe both spouses put $1,000 into each of their personal spending accounts and then put the remaining $13,000 into a joint account. So at the end, this fixed dollar model gives everybody an equal amount of personal spending money. The worksheets that I have on my website that you can also find at thelongterminvestor.com are really useful for exploring these different ways for combining finances. There's a section in the book on what to expect with your finances when you're expecting children. And I go through some ideas on how to accommodate the higher expenses that you are undoubtedly going to experience. For example, when you're pregnant, I think it's smart to immediately open a savings account and start a monthly contribution that gets you prepared for the less amount of discretionary income that you're going to have. Plus, it gives you a little kid-specific rainy day fund for any unplanned expenses. Next to the chapter, I talk about saving for your kids' education, and there's no denying the benefits of a college education. There's also no hiding from the cost. And with all savings goals, the earlier you start, the better you can leverage the power of compounding. I go into quite a bit of detail about the best vehicles and strategies for college savings, but for the purposes of this particular conversation, I'm going to focus on two things to keep in mind when we're talking about savings for college. First, and maybe most important, is to remember that your kid can always receive financial aid or take out loans to pay for college, but there is no such option for your retirement. If you're going to postpone retirement savings, that means you're going to miss out on decades of tax-deferred compound growth, and it's going to be hard to catch up later. As the father of two children myself, I completely understand the desire to give your kids everything they need to have the best education possible. And for what it's worth, I plan to pay for my kids' college expenses, but I'm always going to prioritize my retirement savings first. Because I'm pretty sure that if my kids had a choice between taking out a loan for college or me living in their basement during my retirement, I'm pretty sure they'll choose to fund their own education each and every time. So that's the first thing. Remember, you have to prioritize retirement savings. The second thing is that you don't necessarily have to save 100% of the expenses by the time they graduate high school. At PlanCorp, we typically say that a good target for college savings is 70% and plan to pay for the rest from your cash flow at the time. And there's a few reasons why. First of all, you can't know that your kid will even go to college. Second, your kid may receive a scholarship. And even though a lot of the savings vehicles will allow you to withdraw the amount the child earns in scholarship out without penalties, oftentimes that savings could have been allocated more efficiently, either from a tax standpoint or a growth standpoint. And finally, it's difficult to predict the type of college your kid will attend. The difference between an in-state school, an Ivy League school, or anything really in between is massive. And so, again, that 70% of projected college costs, that's a decent bogey to go for. And then paying the rest out of pocket, it gives you a little bit more flexibility and allows you to maximize your savings appropriately. The final section of Chapter 10, as I mentioned earlier on, is buying a home. Home ownership has long been part of the quintessential American dream. And it comes with a lot of intangible benefits that are difficult to quantify, but there is obviously a financial aspect you must consider. Because a house and a mortgage are very likely going to be the biggest items on your net worth sheet. So the math needs to be taken seriously. In this section, I start with asking the question, when does it make sense to buy a home? Whether a home purchase makes sense depends on several financial and emotional factors. So I share a series of questions and exercises that, when answered truthfully and realistically, should help you make an informed decision. Admittedly, the exercises largely overlook the emotional part of buying a home, but my goal for this portion of the book is to help you make the best financial decision for long-term success. After that, I address the point where you've decided to buy, now what? Because throughout the home buying process, there's a lot of pressure to spend, and I remember the publisher really wanting me to come up with a sexy way to calculate how much house you can afford. And I think I came up with something somewhat reasonable, but I'll be honest, there's not really a perfect equation for every situation, and more importantly, every geographic market. I like to generate three numbers and use that range to inform the decision of how much you can afford. So there's the exercise in the book that uses a formula that involves gross monthly income, the total amount of monthly payments you're making to other debts, like student or auto loans, the mortgage rate, and the down payment. The second number I'll use is simply 2.5 times your gross income, which is pretty easy to calculate. And the third number is choosing a home that results in a mortgage payment equal to 25% of your monthly income. Finally, in the home buying section, I cover some common mistakes people make when buying a home. In my opinion, the biggest mistake is that people don't live there long enough for the finances to work out. And I also think that people sometimes make mistakes because they're looking at their home more as an investment rather than a form of consumption. Because in the end of the day, the house, if you're owning a single house, it's a use asset. It's not really an investment in the professional real estate investment sense. On to chapter 11, which is titled Big Financial Decisions at Critical Junctions in Life. This chapter focuses on some decisions that impact you and your family's well-being: estate planning, life insurance, and disability insurance. And I can't possibly do these topics justice by quickly summarizing them, so I promise to cover each of these in greater detail in a later episode, but I'll also link to some of my blog posts on these topics in the show notes. But here are some headlines from the various topics within the chapter. With estate planning, I explain why you need an estate plan, the primary components of a complete estate plan, what happens after you create your estate plan, and some common estate planning mistakes. And for what it's worth, I have a relatively comprehensive blog post on the topic, so I'll definitely link to that in the show notes. For life insurance, I explain when life insurance makes sense and how much you need, what to consider before buying life insurance, including the differences between the different types of policies, as well as some guidelines for choosing the right type of policy. And then finally, I wrap up the life insurance conversation with the common mistakes people make when buying life insurance, which is actually one of my favorite sections of the book because I share a series of common one-liners that insurance salespeople give when trying to talk you into a policy that might not actually be in your best interest. And then finally, for disability insurance, I explain the importance of disability insurance, which took me personally a really long time to wrap my head around. Just think about this. You're more likely to become disabled during your working career than you are to die. Obviously, everybody dies, but during their working ages, the statistics say that you are more likely to become disabled than you are to die because accidents can happen everywhere and illness can strike anyone. And if you're like me and delayed this coverage due to its high expense, my hope is that this section of the book will maybe be the prod you need to stop procrastinating and start protecting what might be your most important asset, which is your earning ability. I also have a section that explains why most people don't get disability insurance in the first place. And finally, I go through considerations when purchasing disability, because I think this is important just because it's so high cost, but it can also be highly customizable to your needs if you know how to navigate the features and the risk trade-offs. Chapter 11, I think maybe one of the densest and most complicated in the entire book. While many people can implement an efficient saving system and implement an investment program that's disciplined, it's a far bigger task to sufficiently plan for the unexpected death or disability. And consequently, you may find yourself needing to hire a financial professional. But before hiring a professional, you need to understand those different types of advisors and how to identify the right one for you. Which takes us to our final chapter, chapter 12, how to create your own team of professionals to help you succeed. Financial planning is more like an ongoing full-time job than a one-time task to tackle. But hiring a financial professional often makes implementing a comprehensive financial plan much easier and far more effective. And obviously I'm biased, but allow me to share a quick story from the book to give some more context to my suggestion to hire help. When I bought my first home in May 2010, I was dead set on having a big yard. And that bigger yard obviously came with bigger responsibilities, like mowing it. And it generally took me about 90 minutes. I always felt like the time commitment was manageable, and I didn't even really mind it so much. But there were some occasions, however, where I didn't have time to cut the grass. Sometimes it was due to a commitment, and admittedly, sometimes it was due to me just being lazy. In an ideal world, fitting in 90 minutes for lawn care shouldn't be a problem, but in real life, things happen. Stuff comes up. Other opportunities present themselves that sound a lot better than doing chores. But those times that I postponed the yard work meant that I was dealing with much longer grass when I did finally get around to mowing it. And longer grass meant that it took more time to cut, and the lawn just didn't look as nice. And even worse were those times where I put it off a day, but didn't look at the weather, only to be surprised by multiple days of rain. And then cutting the grass really became a problem. But all in all, I got by just fine. My lawn looked pretty good, and I didn't see a reason to do it any differently. But that all changed the summer I hired a guy named Leo to cut my grass for $35 a week so I could spend more time with my wife and my newborn son. And Leo did all the little things I wouldn't have thought about or known how to do properly. He periodically changed the direction in which he cut the grass to encourage healthier growth. He fertilized and seeded strategically. He cut the grass a specific length depending on the weather conditions or if an area was exposed to the sun more so than others. He edged around our flower beds and plants. And in the end, we had a dramatically healthier and superior looking lawn. Not only that, but hiring Leo gave me more time to focus on the things that were more important in life. I feel like people who take a do-it-yourself approach to any job, be it landscaping or financial planning, do so to save money or because they enjoy the work. And do-it-yourselfers also tend to be okay with just, quote, getting by okay or getting by just fine, as I was with my lawn. But the difference between just fine and doing well with your money is pretty significant. And much like Leo did a lot of things to help improve my lawn's health and its appearance, a financial professional does things that you would never think to do. There's a quote in this chapter that I like, quote, "Building and executing a financial plan is not necessarily rocket science, but not knowing what you don't know can seriously limit growth. Plus, mistakes can cost huge amounts of money," end quote. Unfortunately, the mistakes and missed opportunities aren't always obvious to do-it-yourselfers because they don't really have the tools to accurately evaluate their financial life. There's a study that I reference in the book. It's an ongoing study from Vanguard that estimates that financial advisors add about 3% in relative return to an individual's investments. And in the book, I outline the best practices that contribute to Vanguard's estimate. And of course, the value of an advisor is not consistent over time. You shouldn't expect that an extra 3% shows up each and every year. But there are times where fear or greed may tempt you to deviate from a really thoughtfully crafted investment plan. And in this instance, your advisor could add tens of percentage points by guiding you to stay the course and avoid losses. And it's these type of valuable interventions that can offset a lifetime of fees. It's also worth pointing out that this ongoing Vanguard study, it doesn't attempt to quantify the value of comprehensive financial planning because, as the authors noted, we don't need to see oxygen to know it's beneficial. Again, I'm obviously biased in thinking that choosing a good advisor is one of the best decisions you can make, but I'm definitely not naive to the fact that choosing the wrong advisor can do more harm than good. So I do dedicate a part of the chapter that focuses on how to choose a financial advisor. Because if you're going to hire a professional, the biggest investment you can make is in the time you put into selecting the right person. To me, this starts by just simply understanding the differences between professionals in the industry. Because two professionals can go by the title advisor, but it doesn't necessarily mean they provide the same service or even adhere to the same ethical standards. So I go through the different standards of care, like the fiduciary standard, which means that you have to put your client's interest first at all times. The lesser standard out there would be like the suitability standard. So I don't have to necessarily go through all those definitions right now. I'll put a link in the show notes about the differences between the fiduciary and the suitability standards. I also go through the various advisor titles and credentials, because while a job title might have some relevance to a firm's internal hierarchy, you can basically start with the assumption that all job titles are a form of marketing. So there's really no reason, in my opinion, to worry whether your advisor's title is wealth manager, planning associate, financial planner, portfolio manager, financial consultant, financial specialist, director, senior vice president, president, principal, partner, and so on. Whew, running out of breath there. There are just so many. And I haven't even named all of them. You see all sorts of different things. Just remember, the title doesn't necessarily matter in the context of trying to find the best financial advisor for you. And while it's certainly difficult to understand what someone can do based on their title, I think the hundreds of professional designations out there are even worse. Because it's very rare these days that you'll meet a financial professional that doesn't have some combinations of letters after his or her name on a business card. The problem is that not all letter combinations require the same degree of expertise or knowledge or training. So there are 3 designations that I highlight in the book as being more meaningful. I'll also link to an article that goes over these 3 different designations in greater detail, but just to list them here, I go into detail on the CFP, CFA, and CPA. I also explain differences in compensation. So the way financial professionals are compensated can obviously impact objectivity. Fee-only advisors are paid just by their clients. This creates an incentive structure with arguably the fewest conflicts of interest, and the most common fee-only advisor is paid a percentage fee based on the amount of assets being managed, with that percentage fee decreasing as the account size increases. Other fee-only advisors charge by the hour or set fixed retainer fees for financial planning services. And because a fee-only advisor's compensation is not tied to a specific product or strategy, they can generally provide objective advice without being swayed by personal benefits. And that also makes it much easier for the fee-only advisor to adhere to the fiduciary standard. At the complete opposite end of the spectrum is the commission-only advisor that earns income on products that are sold to the customers, like insurance or mutual funds. They also earn income from transactions made and accounts open for customers. So the more activity a customer has, the more a commission-only advisor earns. Remember, a commission-only advisor works for his or her company, not for you. And as a result, the recommendations they make can be filled with a lot of conflicts. One subtle distinction is on fee-based advisors, which is different than fee-only advisors. Fee-based advisors can earn some of their revenues from the fees paid by a client, kind of like that fee-only advisor. The fee-only advisor, the only revenue they get is from the direct client. But the fee-based advisor, they can also earn commissions from selling certain products or having certain accounts open at different brokerages. So there are times where fee-based advisors can adhere to a lesser standard, such as the suitability rules, which means their financial recommendations may not actually be in your best interest, and there can be a little bit more difficulty in uncovering those conflicts of interest. Finally, in the chapter, I go through how to choose an advisor, which I'll just break down real quickly here, even though I go into more detail within the book. First, you make a list of firms or people that you know that you would consider hiring. Second, I recommend people visit brokercheck.org to check a prospective advisor's record for any kind of misconduct. And if they're regulated by the SEC, it'll redirect you there as long as you type in their name correctly. Third, I suggest that you go and visit the different advisors' websites, which I'll admit is a bit like judging a book by its cover, but a website can usually have some good information about a person's background and capabilities. And you might also see if the firm has a blog with any content that's relevant to you. And then finally, you can narrow down your list of finalists and use a structured interview. The structured interview process was made popular by Daniel Kahneman, who's a Nobel Prize-winning psychologist, to reduce the impact of bias on our decision-making. But the first time I saw it being applied to financial advisors was in a column by Jason Zweig of the Wall Street Journal. In the book, I provide a list of questions for the structured interview, along with some commentary to help you identify responses that are in your best interest. And I also include some follow-up questions you might want to ask. And after the list of questions are instructions for how to conduct the interview and score it. For your convenience, you can go to longterminvestor.com. You can download the structured interview worksheet there if you don't have a copy of the book. Highly recommend you check that out. Finally, I wrap up the section with robo versus hybrid versus human advisors. Robo-advisor is the industry term for a digital platform that automates your investments for a percentage fee based on the assets under management. And this is a really important growing segment that's serving a huge amount of investors who were previously forced to do it for themselves or work with somebody who didn't necessarily have their best interests in mind. The hybrid advisor is really when you take the robo-advisor platform and add a human that you're able to have an occasional meeting with or ask a really basic, simple question. The digital platform allows you to track your progress and make adjustments, but these advisors give you a little additional value in someone who can help further hone and personalize your financial plan. And then, of course, there's the human advisor who ought to be the most proactive. It costs more because it is personalized. It is more proactive. And when it comes down to it, there's really no one algorithm that can solve any person's financial life. And a human can deal with the multiple different complexities. So I think that this chapter, if you're thinking about hiring an advisor, is a really useful one. So there you have it. Those are the 3 parts of Making Money Simple. Again, if you go to thelongterminvestor.com, there's information to buy the book. There's places to download the worksheets. In the show notes, all sorts of links to things that are discussed throughout the book and on this podcast. Also, when you visit thelongterminvestor.com, you can submit questions for me to answer in future episodes. And if you're enjoying the show, please subscribe to wherever you're listening to podcasts and leave me a review. I read every single one, and I really appreciate you taking the time to let me know what you think. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.